As I sit here today, I'm a finance guy at heart. I've probably got 35% of my net worth tied up in various multifamily projects across the country. I'm in about 1,500 doors as a general partner, and
Excellent.
that
Okay.
equates to probably well over 200 million in assets under management, the values of those properties. That may seem daunting, but it's really not.
Hey everyone, what's going on? This is Kevin Daisey, your host here on the Managing Partners podcast. And I'm always trying to find unique guests out there. And I'm not sure if you know this about me, but I do have some real estate. Me and my wife, outside of marketing, me and my wife also have some real estate properties, and I'm trying to build that out to diversify. And of course, all my lawyers out there that I know, I talk to often. I know a lot of you that are into real estate. Maybe you're in buildings for your firms. You're looking at other opportunities to put money away for yourself and your families, and build wealth. And so I wanted to bring Randy on the show here because he's deep in real estate. He's got some cool things to share, ways to build passive income, and I hope it's valuable to you. So would love to see if you have any comments, questions. If you can post those when you're watching this, be happy to connect you with Randy or to respond to those questions. And yeah, just trying to bring us something a little bit different here. And Randy, welcome to the show.
Well, Kevin, thanks so much for being on the show. It's really a pleasure to be here this afternoon as we record this. I'm Randy Langenderfer. I live in Houston, Texas today. My wife always tells me that I only talk about business. So I am a husband, a father of many years. I have 3 adult children. I actually have 4 adult children, 5 grandchildren, 3 girls and a boy that are out living their lives. And Kevin, my story started, if I can jump in there,
Yeah,
really
go.
about
Tell us your story.
10 years ago. 10 years ago, after the Great Recession, I was working for a private equity firm in Cleveland, Ohio at the time. And if anybody knows anything about private equity, they're really hard chargers. And I was working my butt off. And I was just really afraid I was going to get laid off. Not because of any performance problems I had or anything, but just because of the economic times after the Great Recession. As an executive, I had a pretty good number on my back that would have been a cost reduction. And that was just a real aha moment for me that, I needed to find another income. And at that time, I wasn't really ready to quit the corporate world, but I started looking at all kinds of things, buying small businesses, buying a franchise, other opportunities like that. And I came upon real estate. I had a brother-in-law that got me first interested in it. We were living in Cleveland, Ohio, and we were hard money lenders to a group out of South Florida, Dade County. That means we were lending them money to buy the houses, repair the houses, and flip them for a profit. And we would take very nice return percentage-wise on the gain. So that's how I got started, and then moved into multifamily when I was looking for a job and moved to Houston, Texas from Cleveland, Ohio. And I got involved in I became the chief compliance and privacy officer and cybersecurity exec for a large academic medical institution here in Houston. And so I've worked with a lot of attorneys. I've had attorneys work for me on the corporate side, and just really a pleasure to be on your show and spend a lot of time with attorneys, put it that way, on the compliance side.
Yeah, well, I appreciate you joining me and interested to talk about some of this stuff. I just have some single family homes that are short term rentals, and we've done good, and we're scaling it up. But multifamily, I've been to some of Grant Cardone stuff in Miami and
Yep.
and learned a lot about that stuff. I had a client here, actually, a non law firm that owned like 60, multifamily complexes, 50 million, $60 million per property type stuff. And, he lives right here where I'm at, and very
Yeah.
intrigued listening to him, and going, how can you get into that? And how is it even possible? No matter what your income is, how do I get into a deal that size? Now I think it's a little daunting to think about. So So I'd be interested to see like
Well,
your perspective on that.
well, it is daunting when you're at the bottom of the mountain looking up, or when
Yeah.
I was in 2011, 12, thinking about what in the heck am I going to do. It is daunting. And I would say there's nothing wrong with, I mean, there's many different ways to make money in real estate, from single family to multifamily. But um, what I learned in single family, doing the hard flips that I was doing, it's just very difficult to scale, to get a
Mm-hmm.
lot of traction. And it was limited to the amount of money I had. So how much money could I put in a building or an apartment or a single family unit to buy it and flip it? My partner and I were the bank.
And you don't have
So
the
we were
cash. You don't have the
somewhat,
cash flow, right? You're not building the cash flow up.
you're putting out a big outlay and hopefully getting it back in 6 months, maybe 9 months.
You got capital
So
gains. You got all the other things. You got to just keep.
you got it's
I guess you just got to
it's
keep
not even
stepping up
capital
and
gains.
yeah,
It's not
1031
even capital
exchange
gains.
and step up, step up, step up. Right.
Yeah, but it's not even capital gains. It's ordinary income flipping houses because it's less than a year. So it's ordinary gains, just like your W-2. So it became heavy taxed. But there are a lot of advantages to it. I was able to graduate into it. But I think the perception that I'm going to go where I'm comfortable in becoming, I'm going to own a big chunk of something. So I'm going to buy a 2-unit complex or 2 houses, and you are the man per se. And I don't want to be the person that's getting called for the toilet leaking in the middle of the night, or the air conditioner going off in the middle of summer, or somebody hit my car in the parking lot. The advantage of multifamily is we hire third-party property management to do that. They're the people on site every day dealing with what I say, tenants, toilets, and termites. So that's the real advantage to some of this. And so the other one is from an investment perspective, I mentioned I was at the Baylor College of Medicine, and I got to know our chief investment officer real well. And when I first started there 11 years ago, almost 12 now, it was the traditional. We had a $1.5 billion endowment. That's with a B, billion.
Yeah.
And we had the traditional asset allocation that everybody preaches about. So I'm a finance MBA, CPA, so I'm all into asset allocation. Had a traditional model of 60-40, 70-30 equities, bonds. Well, over the ensuing time period when I left there, of that 1.5, we had anywhere from 8 to 12% of that portfolio allocated to real estate. And if you look at some of your bigger allocations from your endowment funds, they all have a chunk anywhere. So I'm going to say 8 to 20%, just on how aggressive they want to be and where they are in the cycle, devoted to real estate. It's a venue to boost your returns. Yes, it's a longer runway, but it's a venue to boost your returns and complement what you're doing in the market. So today, as I sit here today, I'm a finance guy at heart. I've probably got 35% of my net worth tied up in various multifamily projects across the country. I'm in about 1,500 doors as a general partner, and
Excellent.
that
Okay.
equates to probably well over 200 million in assets under management, the values of those properties. That may seem daunting, but it's really not. It's like owning a piece of a mutual fund. So what I'm comparing it to is you own, or somebody who owns 3 rentals owns a lot and a little. I
Right.
own a little and a lot. So I have a small percentage in a big pie. Those who go after single families one at a time, they own a big piece of something smaller. Neither one of them is bad. It's just that I'm lazy in my old life. On my old age, I didn't want to do all that work.
Oh yeah. My new property has been. It's a short term rental, so it's not a tenant, which that
Yeah.
sounds terrible to me to have single family tenants, but yeah, it's a lift. And then yeah, there's problems. You got resources, but you have to have backup resources, and sometimes there's no resources, so it's you. So, but it was our way in. I've been to a lot of things on getting into multifamily, and I learned what general partners were and all this other stuff, and are trying to do structure your own deal as a general partner. And to me, my decision was, okay, well, I can go buy some stuff now that I feel comfortable with to get my feet wet and to see that it creates cash flow and revenue and increases in value and give me more leverage to buy something else. And that's worked out well so far. But I'm still intrigued with everything out there, commercial, multifamily. And so I definitely
And
want to move in that direction. And anyone listening, if you're not in real estate, you should be. I don't care if you're a owner of a firm or just a law student listening.
a W-2 employee.
Yeah, real estate. Not your home. That's a liability, more or less. You're putting money into that, constantly fixing it up and paying bills. But getting into real estate, no matter which it is just a good way to go. Everyone that I know that's wealthy has real estate. Every single one of them. And the sooner the better, because it's never a good time or the right time to get into it. So
Yeah, and you hit it on the head. The wealthy, if you look, I mean, whether you like or dislike Donald Trump, I'm not political side, but he's done an awful lot for the real estate profession and bolstered its image. And as the one guy told me, Randy, you don't have to be smart in this. All you have to do is follow the playbook of those that have gone before you. This isn't brain surgery. It takes work and some capital, but you know. And I just wanted to go back to the comment we talked about the other illustration. I had a conversation on this very breakfast this morning with a potential investor, and he's the same thing. He owns 3 rentals, and he's contemplating single family rentals.
yeah,
And he's contemplating, does he want to grow that or does he want to go into something different? And I said, again, neither venue is wrong. It's what your comfort level is. But I said, do you want to be, the illustration I heard best put to me was illustration in the airplane. Do you want to be the pilot in the front of the plane who's worried about air traffic control and the weather and ground crews and all the headaches he or she has? Or do you want to be the passenger sitting in the back, sipping your favorite beverage and reading a book and letting everything else to the guy up front? And that's kind of the way a syndication works. You have a general
I want to
partner.
talk about what you want to talk about today, and because I don't know much about that myself, so I'm here to learn just like everyone else. And again, this podcast is hopefully bringing some good information to y'all and to me. Yeah. Again, as the host, I'm learning every time, so which is awesome. So,
well, you've got the enviable seat. You get to hear all your guests, unless your audience tunes in for every podcast, but you get to hear everyone and leverage that knowledge. But absolutely. Yeah, syndication is really just that. I mean, it is a group of investors coming together that's going to buy a multi-million-dollar asset that none of us could buy alone. Period. None of us could buy alone. So there's going to be a general partner. He's going to be the pilot in the front of the plane. He or she is going to be the pilot that's putting the deals together. They're going to be the ones that are finding the deals, working with the mortgage companies, working with the SEC attorneys to make sure this deal is going to fly. And then that acquisition needs lots of passengers in the back sipping their favorite beverage or limited partners. And that's the easiest way to do it. So in a typical syndication, there's I've been in taken down some very big assets with other partners, not with myself, but we've taken down, $120 million deal. I didn't do it all. It took multiple people to do it. And we've done as small as a $7 million deal where it takes a lot less people. And so you just, in the words of Robert Helmsley from the real estate guys, invest where the money, where it makes sense and live where you want to live. So I've invested in assets in Columbus, Ohio, Tucson, Arizona, Greenville, Texas, North Carolina, and Greenville, North Carolina, Columbus, Ohio, Shreveport, Louisiana. It's a matter of finding the place that you're comfortable with the leader or the general partner and their track record and buying into their vision and a goal.
So
just
the
like,
general partner, don't they? So let's just say you're buying a multifamily. Not only are they, there's the money to buy the property, but then maybe the upgrades to the property that they're trying to raise the money for. So then they can
yeah,
then raise the rents and then cash out refi in a couple of years and then pay their general partners back or their limited partners back plus a return, right? Is that kind of how it works?
you've listened well.
Well,
So yeah, when a syndication comes together, they're generally looking at a 5-year hold. They're modeled on a 5-year hold. They may have. I've been in ones anywhere as short as 21 months, and the longest is 8 years, still running for me. So it's anywhere when you achieve the business objective. But generally, the syndication comes together with a pro forma, an investment summary that talks about the opportunity, the asset, where it's at, the local market, what the business plan is to improve that market. And as your audience may or may not know, the beauty about commercial real estate, specifically multifamily, is the value of that property is based upon the cash it is generating, not the comps next door like my primary residence is.
yeah.
So,
Like the property I just bought, I had comps for the houses that just sold down the street.
right.
Yeah, commercial and multi that's going out the window pretty much. They look at how
It
much.
still has an impact, but it's, I mean, everybody, the bank and all the and potential buyers down the road are looking at how much cash is this thing generating, pure and simple.
Yeah.
So the net operating income is the number income minus expenses. It gives you net operating income. And so as the new owner of this XYZ property, if we can increase that NOI, that net operating income, we increase the value of the property. So how do we do that? We either increase rents or we lower expenses or a combination of both. And that's really what you do when you take over any commercial property. You're looking to increase NOI as well as let the market appreciate while the tenants are paying your debt down. It's a beautiful thing.
Yeah, well, so yeah, I'm this is speaking from what I know and I've learned, but I haven't done. But yeah, like say you go in, you reface the building, you do landscaping, you do some, add some new like washers and dryers, whatever.
Yeah.
You don't have to like maybe redo the whole thing, but you're fixing it up. You raise the rents that cost 1,000 units for $100 a month. I mean, boom, that adds up to quite a bit. Or you
Falls
wait,
right.
yeah, or you're waiting for just the rents to go up because you'll build up a percentage increase, each year or whatever it might be.
Right.
But the rents are going to go up anyway, right?
Usually you break your capital plan into interior and exterior items. So interior items are just that improvements you're going to make to the units themselves. You're going to put in new cabinets or counters or plumbing fixtures, lighting fixtures, carpet, anything in between. Some big stuff is recently is tech packages where you can open your unit and control the thermostat with your phone. That seems to be, and we put that in my latest property, and we're getting $50 a month bumps just for that.
Wow.
We took over a property and we started charging for reserve parking. So, otherwise everybody parks in the open lot, but hey, you want a reserve spot, $35 a month. You want a storage locker, another $35 a month. So all those, it's just like any commercial property you see, any commercial thing, the add-ons help immensely to boost your revenue and your NOI, thus your property value.
So yeah. Yeah, and that, I think there's like tons of tax advantages. So if you're a higher earner and you have a bunch of real estate, there's a lot of advantages to having that. And that's most wealthy people have real estate. They like, oh, well, they don't pay a lot of taxes. Like, well, because there's all these advantages to that. So
back to the Trump guy in 2016, well, again, we like him or not, when him and Hillary were debating, and she was criticizing him for paying no taxes, and he said that makes me smart.
yeah.
And so
It's in the tax code.
And it's not tax evasion, it's tax avoidance. Tax avoidance to my legal friends out there is legal.
Yep.
Tax evasion is illegal. I can tell you, I left the corporate world in 23 to do this. I just signed my 23 return today, and I am proud to say that I paid zero income tax for 23. not
I just
because
saw
I'm a
mine
smart guy,
yesterday. So,
but
well,
I'm not bragging or anything. I'm just saying it's the advantage of real estate, and you're taking all those passive losses you've created. Now, I am able to say that I'm a real estate professional designated by the IRS, so I'm able to take those passive losses I have and offset the ordinary income I had. But even if I didn't have that real estate expert designation by the IRS that anybody can qualify with the right qualifications, those passive losses, I mean, there's three buckets of tax. There's ordinary income, there's capital, and there's tax. Just like your capital gains sit in a bucket and they're there to your losses offset future capital gains, same way in your passive income. So even if you're not a real estate professional, for years, it's a great tax strategy to buy multifamily, to let your depreciation and your losses accumulate so that when one sells, you get a small portfolio of those. It's effectively a tax-free gain. You're just punting it down the road. And again, I didn't develop it. I didn't think of it. I'm just following the playbook.
well, too, isn't it as a limited partner in one of these deals on a, let's say $100 million property? I mean, so you're getting the what is it depreciation off of
Bonus
it.
depreciation year one, and
Yeah.
then depreciation every year. So, I mean, the beautiful thing about real estate is you should get a positive cash flow as a passive investor, quarterly or monthly, depending upon the property, and a negative or a tax loss every year on your tax returns until you sell the property. I mean, you're eventually going to have a gain, but yeah, I mean, so you have favorable tax treatment and positive cash flow. And depending on how active you want to be, if you want to go out and find buildings, that's great. Or if you just want to invest and reap the advantages, that's great too.
That's interesting. So, the other thing too that I've learned is, maybe you can explain this real quick, is say you bought your own building. Say I go buy my own 20-unit building or whatever, and
Mm-hmm.
I fix it up, increase the rents, go back to the bank and say, hey, it's now, and they go, all right, now it's worth this. Sometimes they give you a lot more than what you paid for it. You can do a cash out refi as a tax-free event, correct?
Can you do that on your personal property? No,
No.
no. I mean,
So
if
you
you
actually
went
get
to,
your
if
money
you,
back that you put in, still have a positive cash flow on it, and take your money off the table, roll that right
yeah,
into the next deal.
the
Or
only way you could do that in your primary residence, like I said, is to sell it, is to take advantage of the appreciation. So you hit it on the head.
yeah,
You buy a property, you've increased the value by increasing the rents. You didn't do anything else. You're just making it a better property and finding better tenants, and you're getting more revenue. So back to my equation, your NOI goes up substantially. The lender is going to let you refinance that. You're right on the NOI value, not what the comps are saying. And when that happens, many times you'll get a cash out refinance for anywhere from 50 to 100% of your. I mean, the best thing to do is to get all your money back and hold it,
yeah.
and that becomes an infinite return. Then, when you get all your money back,
Infinite
now
return.
I mean, think about that. You put, let's say, $50,000 in a building. 5 years later, you get a cash out refinance. You get all your money back, and the group decided to hold the building. That's a beautiful thing.
Yeah, so
You don't pay any taxes.
I wonder for people listening that aren't familiar with this kind of stuff. Like, so yeah, let's just say right now I have, and I've heard different numbers. Some of these general partners that have different thresholds and things like that. But for some people listening, they're like, "Oh, well, how much money are we talking about here, and how do I get into a deal or whatever?" And I've seen stuff where it's $100,000, or it's different levels, and some are higher than others. But just for people listening, like, what kind of deals have you seen out there where if I want to be in a deal, limited partner,
Yeah.
what's kind of the minimum entry level?
The general rule of thumb, I'd say, as any rule of thumb, there are exceptions, but the general one is $50,000. So you'll see some bigger assets where you ask for $100,000. They want to get fewer $100,000 investors versus many $50,000 investors, just so they don't have to deal with investors.
Sure.
And from that perspective, it makes sense. But from the average investor wanting to get in this, and then you can go out to crowd-funded sites today, and you can get in this for as little as $500. I wouldn't encourage that. But for the typical private placement offering, of which these all are, They have a requirement of, I'll say, anywhere from 50 to 100,000. There are
Okay.
deals that if you want to put in more than that, you'll get a bigger return. I mean, if I put in 500, you're going to get a bigger return than the average LP.
Yeah.
But as a general rule of thumb, I would say 50.
Okay. So yeah,
100
I
is
mean that was kind of
and
some
yet
of the
there's
numbers I heard, but I think most people would be like, all right, it's $1 million. Like, how much do I have to have set aside to do this and get into a deal? And so yeah, it's not.
the other one I wanted to say is on that one is Kevin. I'm sorry, I didn't mean to interrupt you.
Oh, you're fine.
Um, the easiest way to get in there is even high income earners say, I don't want to put 50 grand in my first deal. So the way I got started in my first deal, because I'm a finance guy and very risk adverse, I started a self-directed IRA. So I took some of my IRA money and invested. You can do this very legally. You just have to transfer out of the Fidelities or the Schwabs into a different custodian. The biggest one is Equity Trust in Cleveland, Ohio, or Quest Trust Company here in Houston. Transfer your money there, and then you can invest in crypto, real estate, anything you want to invest in.
Nice.
So there's a venture there too.
So don't take your life savings and throw it into a deal, right?
Well, certainly don't take. Yes, I mean I've actually advised people not to invest because I don't want to be the guy that takes their last $50,000,
Yeah.
and they got a kid going to college in 2 years or something, and no, it's not worth it.
Yeah. Well, we got some good earners on this audience here on this show. So yeah, I just everyone listen. I just think we're focused on growing our firms. My marketing firm, your law firm, but we gotta be looking at these other things and put our money elsewhere and having it grow smart. I think another thing too is if you like, I know my building here that I'm in, we're owner occupied. My business partner bought this building himself right before we kind of formed our new company, and he was already buying this building. I had a lease on a building in Virginia Beach. He was buying this. We decided to come here. We pay him a profit every month to be owner occupied. This has gone up a ton in value. And again, he makes, we pay him more than he owes on it. That's for sure. And so it's a good investment for him. And now he's got like 6 commercial properties plus a couple of short-term rentals, and he's looking at different opportunities there too. So there's a lot of things you do if you have a law firm, owner occupied, buy your building, rent out, the extra space that's available. I think there is like a percentage that you have to be occupying for certain SBA loans and stuff like that. But there's some advantages, some loans you can get out there too for that kind of stuff if you're owner occupied with some good rates, SBA loans with good terms. So there's a lot of opportunities, of course, out there for real estate if you're, that you can
If you're
do
serious
through
and if you're
your
looking.
firm. Yeah.
And yeah, I like multifamily, primarily for the reason everybody needs a place to live. Not everybody needs an office building or a strip mall or an industrial park, the other commercial real estate classes. But in America, everybody needs a place to live. So that's the thing I really like to it. And when there's a shortage of houses, units, whatever you want to call it, across America, and that isn't going to change anytime fast because we're not building them fast enough, and the barrier for people to buy them. So, the millennials, I have 3 millennial children, and only one of them owns a house, only because they make good money, but they don't have, and daddy's not going to give them the down payment. So we are becoming a nation of renters.
It is. I was going to say, yeah. So totally agree with you. Yeah, and you think about the pandemic, like office space and commercial space was devastated. And if you owned a bunch of rental space for office space, it wouldn't be very good for you. If if you have a law firm where you're always going to be physical, you want, own your building and make money on, to rent out the other parts of it, that's great. But to your point, Randy, yeah, more people are not buying, and younger people they're waiting longer to purchase homes. They want to be flexible. They want to move around. They want to not be stuck with something. And so, yeah, there's going to be more and more and more multifamily. It's not going to be less of it. It's going to be smaller spaces that are crammed together. So, it's just, and especially with the prices, right? The rates, inflation, and the barrier to entry is raised. So, great investment, and it's always going to be there. It's not going anywhere. That's for sure.
And I'm in Texas. I saw in the Houston area, and I think I saw the average median price of a starter home in Texas is like 350, 370, and that's probably low compared to the rest of the country. But
Yeah.
still, I mean, that's going to require you to have a $60,000 or $80,000 down payment for the newbie. And so if you get a double income, maybe you can do that. Maybe you can save it. And then the other end of the spectrum is you have people like me that are baby boomers that are looking to probably downsize and get out of the house and the maintenance and all the repairs and that stuff. I can still do it today, but give me another 10 years, I probably won't have any interest at all. So there's just a shifting mindset paradigm across the country.
Well, yeah, too. If it's not enough homes out there, and then also, if me and you are in like a 3% interest rate, and I want to buy another house for some reason, like I gotta go to a 7 or a 6, or
Yeah.
so everyone's holding tight. They're not selling. There's not a lot of inventory, and then when there is, the prices are through the roof, and the interest rates are high. So it's a real disadvantage for anyone trying to get in their first home right now. That's for sure.
And
I have a
developers
friend.
aren't building them as fast because of the interest rates.
Yep.
Developers, even in Texas, they still build, but just nowhere near like they did 5 years ago.
Yeah, but if you can build at scale, right? Build, 300 units on a property versus 20 houses. You know what I mean? Where's the money going to be, right? I know a lot of
Well, and
developers, so they're going to
the
go for
latest project I'm
multifamily.
doing, the latest project I'm doing right now is I don't know if you've heard in Virginia Beach, but build to rent townhomes or houses where they're actually um, these are 4 townhomes in a building that are going to be 16, 1700 square foot homes, 2-story homes, 3 bedroom, 2 baths, garage, small back porch. But they're just as they said, they're built to rent. They're not built to sell. And you know, like again, a lot of people willing to pay more for something like that than living in an apartment building. And we just happen to place this project in Melissa, Texas, and it's got a lot of upside on it. We just love it. But another demographic and paradigm change across America.
No, it really is, and it's again, I was just listening to I've listened to all Grant Cardone stuff. Grant Cardone's big in real estate. I think he's like 5 billion plus in management or something like that. But um, I was listening to 10X Mentor. I've listened to his other books. I mean, he breaks it down. He goes through all this. He talks about how he used to do single family and he used to do this and that. And, once he got into multifamily, he's never looked back. But um, because even though I made money on the single families, they were never cash flow and they were never passive. They were always expenses. I had to pay for them. I had to keep them up. I had to do all this, and I made money on the end, but I had to wait, and the economy had to go up, and I had to,
Yep.
and then I had to pick that money and immediately put it back into something else, or I would have been taxed like crazy. So with multifamily, just the advantages are endless, to be honest with you. So I wanted to see, for people listening, and sake of time, is if someone's like, "Hey, how do I get into a deal like that, or what's it really look like?" And then obviously, I want to get how they can connect with you and learn more if they're interested.
Well, happy to do that, Kevin. So one thing I would say is a partner and I that are actually developing a course on a passive investor course, what a passive investor should know. And we priced it dirt cheap just because we want to give back to the profession and kind of help others out. It's only going to be $197. So, and it's consisting of like 6 modules, online modules that you can take at your own leisure. It's going to give you a really good introduction to how to be a passive investor.
Nice.
And that's you can go out and look at the website. It's Multifamily Maestros, all one word, multifamilymaestros.com. The passive course isn't out there yet. We got an active course out there of how to find a property to buy. but we're coming out with that because we just found a lot of people are like this, want to understand, well, how do I do this? And the simple answer of where you find deals, I was just recording a session on the passive course saying there's no 12-step process. It's hang with people. And I say, you'll find what you seek. If you're looking for a new car, you're going to find a new car, or a red Bentley. You're going to find a red Bentley somewhere. There's meetups, there's podcasts. You can get on my mailing list when I have opportunities like this BTR project in Melissa, Texas. So there are opportunities, just a matter of how fast your audience wants to go. Love to chat with them whenever, if anybody wants to talk about anything legal or professional, though I'm not a practicing attorney. So.
No, well, I appreciate that. And I think, for everyone listening, to learn more about exactly what he's talking about and pretty much what he shared today, like I probably spent $10,000 to go to an event,
I have too.
Real estate type event. And, but there's those that are out there and you meet tons of people. And I had a Slack group that we created that had like 100 and some people that were all into this kind of stuff. And so there's definitely a lot of information out there, but you don't have to spend $10,000 to go to an event to meet people for the first time. So, it's good that you have this information out there. So, I would definitely take a look at what he's got. And again, this episode might not be for everybody, but if you're looking to take your money from the firm that you've, and put it elsewhere and build that up and protect some of that, honestly, and having tax savings and passive income. These are things that I'm looking to do and doing. And I hope, again, you folks out there and good friends
Kevin,
of mine, attorneys are interested. So,
I was just going to say, if I have one thought I'd leave your audience with today, some people that are very smart, most of them are a lot smarter than I am, is really just invest in your education. Think of the money you spent investing in your legal education and your undergraduate education. If it's not with me, spend a few bucks with somebody else to learn it before you invest in it, just so that you're comfortable with it and you begin to know, like, and trust those you're investing with. So education is a lifelong experience for all of us. Yeah,
it's, I'm always trying to learn. So there's great books out there. Just like you're reading all the business books, or if you're learning marketing with, kind of stuff I do, there's good books out here for this. There's people to follow, influencers. What's the guy? His name's Ken.
Ken McElroy.
Ken McElroy is great YouTube videos. There's a lot of good information out there. So just if you're not familiar with this kind of stuff or multifamily, I would suggest exploring it and getting familiar with it. But if you have any questions, ask me or connect you with Randy here if you're looking on LinkedIn or wherever you're seeing this episode. If you're driving your car, ping me, reach out, and I'd be happy to connect you or talk to you for as much as I know about it. But I'm not playing the game yet, so that'll be next. But this is motivating me to do it for sure. So I'm excited about it. Randy, anything else you want to share before we go?
Just a large thank you, Kevin. It's really been a pleasure. I've been trying to talk to separate audiences like this, and the legal audience is one that is really should be thinking about that, back to where we started on diversification as well. And sure. It's just a great way to build generational wealth.
Yeah, well, I appreciate the conversations before and during the recording. And everyone, just get out there, live the best life you can. Work on your firms, grow on your firms, but make sure you're putting some of that somewhere else that's going to grow and build wealth for your family. So we'll see you all soon. Thanks for tuning in. Randy, I appreciate it very much, and we'll talk to you all soon.
Thanks, Kevin.